David from the world famous Nerd Enterprises Incorporated, bringing to you another special screencast. This time we're talking about technical analysis, and I'm going to make the assumption that you've read the blog post so that you'll have some idea of what I'm talking about here. If not, I would honestly pause the video, go back and read it, because there's some important information in here that I'm going to be talking about. So with that said, I was recently at a seminar, as you will read or have read in the blog, that was put on by a gentleman by the name of Brent Wilsey, who is the owner of Wilsey Asset Management. And the seminar was about smart investing. It was about how to look at a company and determine if its true value is better or worse than what its current market price is. Now, he was talking about the stock market and investing in companies, but my point here is to say, let me take that information and look at things from the standpoint of how a guy like Mr. Wilsey looks at a company when he's deciding whether or not he wants to buy it, and apply that same kind of thinking into the clients that I consult with, and looking at their companies, their balance sheet, from the same standpoint and saying, is this a company I'd want to buy? And what I'm getting at is, I already do forecasts for clients. In a few clients' cases, we literally pick apart the financials line by line. Twice a month we go through it and make sure that things are happening in line with what we expected. We do our projections and we look at the variances each month and see, for each line item, did we do better or worse than we did in the previous month? And based on that, do we need to adjust our projections going forward? And we're making adjustments constantly, because the reality is things change. Things almost never happen exactly the way we plan, but we have a rough idea. We have a pretty good idea of how things are going to go. And by doing this and adjusting it, we're making sure that we stay on track. So now what I'm going to do in this series is I'm going to start off very simply in this video and talk about some of the very basic financial statement ratios that we should all be taking a look at. Whether it's for your own company or if you're somebody like me who consults with other people, you definitely want to, or let me put it this way, it's definitely a good idea to start getting in the habit of looking at some of these kinds of ratios, because they give you very important information about a company and how it's doing at a glance. So what did I do? I took some of the information that I got from Mr. Wilsey's seminar, and I started to develop an Excel template, of course, because we're going to be dealing with formulas and calculations, very simple ones. There's nothing more complicated here than addition, multiplication, division, and subtraction. But it's a matter of knowing what to perform these operations on in order to come up with the results. So what I started doing was I started creating a data entry template here in Excel, where the first thing you're really going to do is key certain information right off the balance sheet and the profit and loss. There's no thinking required here. You're just going to lay it all out. And so if you're somebody who's inclined to create your own, then this is how you'd want to start doing it. You'd want to start just creating a template where you can just lay the information out. I always start with the balance sheet information and then move into the P&L information. And right now, ignore the title. It says last fiscal quarter. In theory, that's how I'm doing it. But for this purpose, I just ran a balance sheet and P&L and a sample file in QuickBooks so you can start to see how I would look at this. But in a real situation, I'm doing this recording May 24th, 2011. I'd be looking at this realistically in terms of what did things look like for the quarter ended March 31st of 2011. And then I'd have the annual information for 2010, 9, 8, and 7. A lot of times we want to look back 3-4 periods if we can. 5 years is a typical projection as we do 5 years into the future. So with that said, you would lay the information out, and I simply pulled it off the balance sheet. It's a very easy process once you've got the layout done. So I've got my total current assets is right here, $299,842. Now I'm using whole numbers here. I'm not bothering with pennies when we're doing this kind of analysis. It's just not necessary. So I lay the information out here, and then we're going to look at these financial strength ratios just to get started with in this video. So let me enlarge this a little bit, make it easier to see. So the first thing we look at is working capital, current assets minus current liabilities. The idea here is, how liquid is this company? If I had to pay off all the liabilities today, do I have enough in assets from which I could do that? If I do, that's a sign of a healthy company. And this tells me that when I take my current assets, which is all the assets that theoretically could be liquidated within a year's time, then I have more than enough based on this, because the number is positive, to cover all my liabilities. In fact, I have enough to cover my liabilities plus $256,219. Is that good? Is that bad? I really don't know unless I look at other companies in the same industry and about the same size to see what their working capital number looks like. Then I thought this was an interesting one. Working capital per dollar of sales. What this tells me is that I have enough working the amount of working capital I have, cash in the bank, money I have to work with, is about 50% of sales. Is that good? Again, I don't know unless I compare it with other companies of similar size in the same industry. But actually, when I'm looking at analyzing in the context that I'm talking about, which is really looking at my own clients and looking at forecasting their financials, then I don't even care about other companies in the industry. I want to compare them today with them last 6 months ago or whatever, sometime in the past. And then I also want to be looking at my forecasted financial statements, my projected balance sheet, and see, does that working capital per dollar of sales get better or worse? In general terms, what's better? Well, I would think I would want to have as much working capital for a dollar of sales as possible. So, in a perfect world, this might be 100%. I might have as much in the bank as I generate in sales in a given month or in a given year, whatever the case might be. The idea is to see, I would want this percentage to go up. Looking at the next one, the current ratio, current assets divided by current liabilities. What this tells me is that I'm in a very good position to liquidate my liabilities if I have to. 687% is pretty good. It means I can pay off my liabilities many times over if I had to today. Then we have the quick ratio. The quick ratio says, let's take inventory out of the equation because maybe it won't be so easy to liquidate my inventory if I had to. So let's take that out of the equation and then see, does it still look as good? Well, obviously, if I remove an asset or portion of the assets out, then it's not going to look as good as the current ratio. But in this particular case, you can see that removing the inventories doesn't make a substantial difference. I still have plenty in assets to cover my obligations or my liabilities. Finally, we have debt to equity. So we look at total liabilities divided by shareholders' equity. This becomes much more meaningful. If you look at this company's balance sheet, there's not a whole lot of debt on the books. I have my accounts payable, and I have, let's make this a little bigger. I have my payroll liabilities and some sales taxes payable. This becomes more meaningful when I have real debt on the books, and by real debt I mean monies that I've borrowed, for working capital. If I have loans, if I have lines of credits, this becomes much more meaningful because it's going to give me some measure of how is that debt working for me. When I borrow money, the idea is to use that money to turn over sales to generate a profit. That profit goes into the equity section of my balance sheet. I'm hoping to see that equity increase with time. So I want to see this ratio improve, and what that means is I want to see this ratio go down. Ideally, over time, I pay down that debt and the equity increases. But even if the debt stays the same, if I'm only paying the interest, but as long as the equity increases, then this ratio is going to improve. The debt to equity. This is a percentage I want to see shrink. I want it to go down with time, either because I'm increasing my equity and not taking on any more debt, or I'm increasing my equity and I'm paying down the debt, which means this ratio would shrink that much more quickly. Right now, there's not a whole lot of liabilities on this company's balance sheet. We've got $43,000, which is why these other ratios, mind you, look so good, because look at their cash. They have $107,000 in the bank. They've got $688 in the cash register, savings of $45,000, and they have accounts receivable. So another thing to look at possibly would be to take accounts receivable out of this equation and say, well, even if I couldn't collect all my debt, how much do I have in terms of true cash liquid in order to satisfy the liabilities? Either way, this company is still going to be looking very good. But these are some simple ratios to start with, and like I've said, it's important to have something to compare them with. And in the context that I'm discussing here, what I'm thinking is we want to compare ourselves today versus another point in time, either compare it to where we were 6 months ago or a year ago to see have we improved or not in terms of what these ratios tell us. And also, when we do our forecasts, when we do our projections, we want to be able to look at, if I'm forecasting my financial statements, and if I haven't looked at this, and I've got it all together, I've got my assumptions in place, all the formulas are written, everything's been extended out for a year or 2 years, then I want to look at those projected balance sheets and see, do these ratios improve, or are they the same? Maybe I want them to be the same. Maybe I'm good right where I am. It's not a question of what's right or wrong. It's more a question of how do I use this information to evaluate the performance of my company from a financial standpoint, because then I can start setting goals. And this company looks pretty healthy right now. On the other side, I might look at this and say, well, something's wrong. Maybe we're not being efficient. Maybe we're not using our assets wisely. Maybe instead of keeping all this money in the bank, we should be investing it in the growth of the company. So The point being that just because a ratio like this looks so high doesn't mean it's good. It has to be interpreted and analyzed. And this is the kind of thing that I already do for clients on a much more macro level. Now, thanks to Brent Wilsey and the seminar I recently attended, I'm going to start looking at it in much greater detail, looking at ratios like this for clients and seeing, are we getting better? Are we getting worse? Are we, could we be making better use of our resources, our assets? Is money sitting in the bank and earning interest in a savings account really worth my while? Or is there some way I could be spending this to increase the growth of the company and increase sales, increase profits, and so on and so forth? The end of the day goal for most companies, I think, really is to build up the equity section, is to build up, that's the book value, that's the net worth of the company. I want to increase the net worth of my company, especially if I am hoping to sell my company someday. That's what investors are going to want to see. They're going to want to see a company with healthy ratios whose equity is steadily increasing. And if you're a small corporation and you're pulling all the equity out of your company in distributions, guess what? Your equity section of your balance sheet is not going to look that healthy. So you want to make sure you're building that equity section of your balance sheet. That's a good general guideline and goal to think about when you're thinking about how do I manage the financial growth of my company. There's a lot more to it, and we're going to do a series of videos now on technical analysis. I'm going to get into much more detail on this. As you'll see here, I'll give you a quick sneak preview into this template where we really start getting into the ratio comparisons. We're going to start looking at every area. We're going to start looking at valuation, dividend percents, growth rates, financial strength, management effectiveness, profitability, and we're going to look at efficiency. So stay tuned, check back, and please post your comments and questions below and around this video or a blog post or wherever you're seeing this, however you're seeing it. We'd love to get your feedback, would love to see your comments, and would definitely love to get some questions that I can use to either simply answer them right there in the comments or record another video if the question warrants it. So go ahead and post your questions. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.